Yeah, so maybe we can start. My name is Dirts Līcis, and I'm the board member of Latvian Business Angels, and I'm also the member of the investment committee of the ASP Asset Management. That is a vehicle that invests or via which the angels from Latban invest. A little bit about myself. I've graduated from Stockholm School of Economics here in Riga. I hold a master's degree in finance, MBA. I've been a developer myself for 25 years. I've been a captain on Airbuses for 15 years, and now for the last years I'm just working or doing deals here at Latban. And I have myself, that is quite wrong, I have my own investments, a little bit less than 20, but accounting together with Latban investments, yeah, more or less 30 investments in different angel businesses. So today I'll tell a little bit more about the pitch deck, and a pitch deck from you as or me as an investor, and what we should be looking at. And a pitch deck is some kind of, usually it consists of 8 to 12 different slides. There are, for more serious or more developed startups, there are 2 pitch decks. One pitch deck is for events like today, when they pitch for 3 to maximum 5 minutes, and their main goal is just to get investors or our angels' attention. And what is a pitch deck? Pitch deck is a sales document and not necessarily the truth. So what they tell you is something that they want to catch your attention. And as Raima said, that many times there are very opportunistic market sizes, very opportunistic or very low customer acquisition costs, and that is what I will briefly touch upon in my presentation. And your job is not to be impressed by the new hype, by the new idea. Me personally, I'm always skeptical, I'm always pessimistic, and I say that this is absolute crap and you will never make it out, and then I just see if they can convince me or not. And your main job is to de-risk the uncertainty. So you have to be realistic, because people who come to sell, they are way too optimistic, and they're so much into their own product that they don't, sometimes they get disconnected from the reality. So you have to be like really realistic and down to earth. And good decks tell stories, and that is the main thing. Like you've heard most probably that good company CEOs are good storytellers. So the same thing goes. We had one, just a little bit off the track, we had one startup who was trying to sell a platform for selling different paintings. And they didn't quite succeed, and the main reason why they didn't succeed was that those people who buy these really, well, a little bit above, not the supermarket paintings, but more valuable paintings, let's say like 3, 5, 7, 10,000 worth paintings, is that they don't buy the paintings that much for what's painted on there. They buy the paintings for the story. And they buy and the same like people might buy different porcelain things. It is not how much that object is worth, but it's more what story you're buying. And it's the same with the pitch decks. These are initial first pitch deck is the story. And good investors always look for the things which are really missing from that story. And the goal of the first pitch deck that the startup comes and sells you is, am I interested enough to have a second meeting? Because in a second meeting you'll have much more detailed review of the business. And the deck's only job is, like I said, to earn a follow-up meeting, not really to close a deal. So you should be really skeptical on all the data, all the information that is there. So basically what startups are being given, like here in Latban events, we give about 3 minutes for the pitch, and then 3, 5, 7 minutes for follow-up questions if somebody has questions. And then signal reading. Every slide reveals how the founder thinks, not just what they built. It is not that important the product, but it is much more important how the founder or how the team member can sell his idea, because his idea might be just brilliant, but if they cannot sell it, then they cannot make any money out of that. And so after checking or following the presentation, you want to answer to a question, do I want another meeting, and do I want to spend next 45 minutes just to have an introductory or more clarifying meeting with that founder. And just like Reima said, for our investment thesis is Reima is much more bigger guy than we are. He's investing much more serious money. Although you are investing much bigger money, we are investing much more serious money, which is our own money.
Well, I have plenty of my own money.
So we are investing at the very, very early stage, which is seed or pre-seed, I would say pre-seed stage. And what we pay attention to is 50% of the weight goes to a team, because a good team can pull off a mediocre idea, but vice versa, like an average team will not manage even with a good product. So we put 50% of the weight in our due diligence to the team, how it works together, how it can sell. Selling is the biggest problem in the Baltic founders team. So they might have a good product, but sometimes they're afraid to sell. Sometimes they don't know how to sell. Sometimes they don't know. They don't want to sell. They just want to keep on developing the product. So that is what we pay most attention to. And so I would like to turn to a question: what a strong team looks like. So domain expertise. Have they lived this problem personally? So we look for founders who are not, let's say, we wouldn't put a big weight for tech founders who have learned how to code something. They have to be coders who have been working into that particular industry, because they have to know this industry in and out. There must be a dedicated salesperson. There cannot be a situation when every team member is selling, because if everybody does everything, then nobody does anything, and nobody is responsible for nothing. So there should be a dedicated sales. So all founders are sales, so nobody can build, everybody is selling, or everybody is building and nobody is selling. So there should be a salesperson. That is very important. There should be, if there is a technical heavy product that the startup is developing, there should be a technical co-founder. It cannot be that the entire team is outsourcing coding or outsourcing something that they're very competent in. Red flags, we're not even looking into the solo founder company, because it is quite common that one of the founders just eventually burns out. So if you take out one founder and he's the only one, so what's left? There is nothing. There is just a company with its name and with debts and unsatisfied clients. And so usually we are looking at companies with 2 or 3 founders. We are also looking at a clear role of ownership. So who is responsible for product development, who is responsible for sales, who is responsible for fundraising, and the CEO usually is responsible for fundraising. And a red flag for us is that the team says, at the moment we're building a product, but when the product is ready, we will hire a salesperson. That is, in our expertise, that is completely wrong approach, because if the product is new, groundbreaking, changing the world and changing our lives, then you should be in it from the very beginning. You cannot come in and sell it like a bread and butter, because that is something else. And you should be in the product from the very, very early beginning, so that you get the feedback back from the clients, what is missing, what you should change, what should be different, how you should adjust your sales. And then, just like Rema said, the prior execution track record at some scale. That is what we're looking, because people who haven't achieved anything, they cannot just become great overnight. So they should have worked or achieved something in their previous companies or their own companies or different companies. And the founders are too junior or spread across ventures. That is another issue. There might be really brilliant young kids who are much, much smarter than I am, but we have to also consider that at the moment they're building the product, they're very excited, but there is a moment when there comes negotiation. If you're 22-year-old negotiating with 50-year-old with so much expertise and experience, most probably you're not going to win your argument. If you're very junior, you might get scared out of different situations. If you're so young, you might not have you're not being able to control your temper. You might just hot-blooded say something wrong, and you just burn all the bridges. That is what the young people simply do not have experience, and that is what we would appreciate. It's not that we do not like these young ones, but we like them under supervision of somebody more mature, or at least a co-founder who is more mature and more stable, I wouldn't say, but yeah. So history of working together under pressure, that is another thing is that we're an angel network, and we go through the due diligence, we talk with them, we talk about fundraising and stuff like that, and how we check how they work together under pressure is when we negotiate the investment deal terms. And of course, like in negotiations, you always come with something more stricter, something more limiting. And of course, they're very shocked that we're so to say, like aggressive. And then you see that they are expecting that they should lose, let's say, half of their company, and then you just see how they behave. And that is the same, like how they will behave, and how will they cooperate amongst themselves when there are some difficult and hard times. And so that is also, like I said, why we don't invest in companies with a single founder. So if one founder leaves, then there is nothing left than just the name of the company. So there must, it is very, very important for us to see that they are very sales-oriented company, because we're investing into the company, like, let's be honest, to make money, not to make somebody happy. And sales is the prerequisite of a company to be successful. So there are, let's say, 4 prerequisites of the sales. So it is not a part-time job. You cannot work in 2-3 startups. The sales guy has to be 100% in, and they have to sell. And in the Baltics, what we see, it's the most common failure is that we will start selling later, because selling later is already too late. You should start selling already the product at the idea stage, and getting the feedback from your customers how you should change your product, because your product will never be ready. It's a vicious cycle. The founder CEO has also runs sales is usually doing both poorly. So if there is a CEO who is running a team, a CEO who is doing the fundraising, a CEO who is the only one who is doing the sales, he cannot concentrate on everything. No partnerships. Many companies, especially the coding companies, say we will just partner with some other platform partnerships, and those other guys will do the sales. That will not happen because nobody will do the sales as good as you are doing. Somebody else will not do good sales for you. And not everyone sells. And like I said, when everyone is responsible for sales, nobody is developing the product, nobody is selling, so nobody is doing anything. So that's why we are looking for very strict guidelines on who is responsible for what processes. The competition assumption, my colleague already mentioned it. When I see no competition on the screen, then that's either the guy is trying to accomplish something that is unaccomplishable, or really like he doesn't know how to use Google, and that's already
Delusional.
I'm sorry?
Delusional.
Delusional, yes. And incumbents are the real threat. Incumbents means that you can develop the best CRM platform that you want to, but the guys are simply used to Excel and email and phone. And why would they have to change it if just you decided something better? They have to be forced to do it, or they have to be willing to pay. Is it faster? Is it cheaper? Is it better sales? So you have to have some kind of motivation to switch, because people, especially my age, are very hard to convince to change things, like especially those which have worked for the last 10-15 years. Why should I buy something different? Why should I learn something if it has worked for 15 years? Most probably it will work until the end of my life. So that is very difficult to break the customs of the people. And what we really like is the founder who maps landscape clearly and explains their specific wedge against each alternative. And they show like that they have really thought about the problem. And there are some founders where we really clearly see that whenever we ask a question, that they have gone through what-ifs scenarios already 100 times, and they know like what if this happens, we'll do this, what if this, we'll do this, and they know actually about their product. Many times it's that after spending one day on their pitch deck and doing the research, I know more about their competitors, I know about the competitor pricing, and that is not really a good company where to invest in. What to probe? So if you have thought about an idea, then most probably somebody else in the world has thought about it, tried it, failed it, or maybe is doing it. So what we are asking people in our interviews is, if you succeed, then you take away the product, the marketplace, the profit from somebody else. And who is that somebody else who gets hurt? For example, now we are doing a syndicate in Vyble, which is an Estonian company. And they are digitalizing the CRMs. CRMs are the documentation that you send with the trucks and lorries for the cargoes. So what is their moat and how do they sell their product is that there is a regulation which comes into force on June or July next year, 2027. So people are just forced, they must go into digital. They will not be able to use the paper CMRs, which are these documentations. So that is the landscape, how they work, how they sell their product. And not only they sell their product not only by making the digitalization of the documentation, but they also sell the information that they will get from this documentation to the insurance companies. So they have thought about their competition already, because there will be competition, and there is competition which is already actually working or already existent in Europe, but nobody from these electronic CMR providers have thought of selling that data to insurance companies. So their moat is like a protection, like that somebody else cannot go and steal your idea. Their moat is that they get this data, they can sell these CMRs at a cost price, but the insurance company will pay them for the information that they give, for the data that they give for the cargo companies. And the other companies are not doing that. And the other companies cannot get the data that they are getting. So they have thought out all the roadmap, and when we talked to them, first they said, okay, we'll do these CMRs, and then I check and I say, well, you have like 10 different competitors. They say, yes, we do have competitors, but we're not competing with them on the price. We are competing on the data that we are collecting, and then we will sell it to insurance companies. Insurance companies will pay us 10% or 20% cut, and that is how we will make money. So they have thought all these what-if scenarios. So for every question that I come and I ask, they already have a set answers. And these are the founders that we really like. And another issue is that companies come and say, we have zero churn. Churn means the clients who are leaving or not using your service anymore or leaving your company. So what founders usually say, that our product is so great that our churn rate is 0% and nobody has canceled. So most probably it means that you have so few customers, and most probably these early customers are your friends and your relatives, that is the reason why they haven't churned. You don't simply have that's called like a small numbers game. Like if your sales are 2,000, then if you get 4,000, then it's already 100% increase, but in money terms, it's nothing really. So that is the customers, and what retention reveals is the retention, like how many of the clients are still using the product in the same level and paying the same money that they used to when they started. And later on we'll have a pitch deck from one of our portfolio companies. That was their first pitch deck, what we read, and we will just go through also about the churn rate and what they think, what they thought was their churn rate. Most companies do have a market illusion, but that is because of the reason that I told you at the beginning, that their initial goal is to sell a meeting with them, the next meeting, the second meeting with them. It's not always true what they're indicating into their pitch decks. And the market is never the whole industry. For example, for Wybill with the CMRs, they said that we are into 8 billion transportation business industry, but they're not into transportation business. First of all, they're only into trucks. They're not into planes. They're not into ships. They're not into pipelines. They're only into trucks. They're not into transportation industry. They're in documentation industry, which is smaller. They're not even in documentation industry. They're into digital documentation industry. And they're not even into digital documentation industry. They're in selling data to insurance company where they get commissions. So they're a brokerage industry. So it is not 8 billion, but it comes down to, let's say, 80 million or 800 million. It's still a big market, but you have to think realistically, what is their target industry? So what the founder said, that we're operating in 6 trillion, and the real market was insurance digitalization, because at the moment all the insurance is being done just on standard risk assessment. And so the question what later on in an interview we asked, like how many freight forwarders there are and how many can you attract, because you cannot attract those big freight forwarders who have thousands of trucks, because most probably they have individual insurance contracts, they have already digital documentation and stuff like that. And then this 6 trillion globally was the entire world, including Australia, South America, North America. But this law applies only to EU, which doesn't include Norway, doesn't include Switzerland, doesn't include UK, which is a big market, so it's even smaller. So if you read about the total addressable market, so be careful. Most probably it is over-exaggerated by several times, and just ask yourself a question: is that company really into that market, or is it something smaller and something more niche? The 10 critical flags that we are looking into the teams. So number 1 is a weak or incomplete team. So each team member should have a specific competence in a specific area. So there should be like IT guy, sales guy, most probably some kind of financial guy. There cannot be platform supplier dependency. So quite many of you have heard about so many evolving artificial intelligence companies who are groundbreaking, inventing something, but most probably, I would say, I don't know exact number, but I would assume like 90% of the companies have just written their prompt, and they're very dependent on the AI providers. So if AI provider comes, as a good example, there was a company, forgot its name, but they were selling their information for biotechnology, for drug discovery, better probabilities for different drugs. And what happened, Cloud just released Cloud Biotechnology or something, search engine. So basically they just died overnight. They cannot compete with Cloud, who is doing the same prompt, only much better in their own platform. So that is called platform supplier dependency, and that is what we're looking for, and that is what we're asking. Is it just a prompt that you wrote, which is hidden somewhere, or is it something that you have developed yourself, and can somebody else just come and take it away from you because you're using their platform or supplier? Then the next one is fake or inflated total addressable market, which I already discussed about. Unrealistic unit economics. CAC means customer acquisition cost. So what happens usually when people or when a team builds its product? Let's say they're selling woolen socks. Then they sell to their clients, they pack it into the package themselves, they go to a bus station, they give it to a passenger. Passenger goes from Riga to Valmiera. The guy in Valmiera just comes and picks it up, and customer acquisition cost is quite, and delivery cost is quite close to zero. Then when you think that you have to deliver 1,000 socks like that, you cannot do like that anymore. So your customer acquisition and service costs will grow. And usually...
Just an example, today I read a tech where they made exactly that mistake, and my number for CAC was 15 times higher than the founders, and founders wasn't zero, it was already 3 figures.
Yeah, exactly.
But that blew up the whole investment case.
So usually our investment stage is pre-seed. So usually for us, we multiply that number by 3. Because if they say our customer acquisition cost is 10 euros, dollars, whatever, we multiply by 3 and only then put those numbers together, because they think that by scaling they will keep the same customer acquisition cost. Very common question and answer is like, how will you sell your product? And they say, well, we will market it on Google and or Facebook, and we'll use free ads. All our competitors are stupid, they're paying for the ads, but we know how to do it better. Well, there is no way. If you know how to do it better, somebody else knows how to do two times better than you. It's not really the competitive edge. There is no real retention data, so you cannot really prove like how you keep your customers. Manual operations disguised as SaaS. We know several SaaS companies where it is very high-tech company, but if well, I have two daughters, and I have read the Estonian fairy tale Lotte, maybe somebody of you know, and there was, I don't know which of those characters, where his wife was mulling inside this special machine, which maybe help me, I don't remember, like automatic washing machine, but basically the wife inside the machine was just spinning the pedals, and it was washing by itself. And that is quite often what happens in those really fancy SaaS companies, that they say we have automatic onboarding, we have automatic risk assessing and stuff like that. And this automatic onboarding is 20 people working in a back office, which which we find out eventually during the due diligence and going to the company and finding out this automatic is 20 girls just typing in the client's numbers, and that is not really.
But there are a lot of examples of this actually. I think one of the biggest and recent ones was from Amazon, where Amazon has these stores where you just walk in and you don't register, and you just walk out with the item that you take from the shop, and it automatically deducts from your Amazon wallet the amount. It turns out it was just 1,000 Indians in a call center just watching from cameras what type of stuff are you picking from the shelves, putting back and exiting the store. Yeah.
Yeah, that.
You can test the concept.
Yeah.
Yeah, but that is quite common. Not funny, unfortunately, but ironic problems that we meet with. Then there is legal and compliance uncertainty. That is what Ansys was yesterday. Yeah. So
The day before.
or 2 days ago, yeah. And that is what he's checking. So for all our companies, they shouldn't have all the legal documentation ready at the moment when we start our due diligence, but by investing, we make sure that they have all the shareholders agreements, all the vestings, all the stock options and stuff like that, which is very important for the next investors. So next critical flag is no financial planning discipline. So as soon as startup founders, most of them are into their late 20s, 30s, maybe like that. They've never seen big money into their accounts. And that is the reason why we do collect money from our members, but we do not transfer it to them immediately. We transfer it in tranches, which is like discipline for them, because many times as soon as they see even 200,000, they think that for 200,000 they can build a factory and sell into all Americas and enter India as well. So that is something that we look very, very carefully. And the next is no defensible competitive moat. I can tell you, like every second pitch, what we get is that we did it over the weekend or during this week, and we're very smart and nobody else knows how to do it. And but at the same time, they cannot really tell why cannot somebody else, much smarter person, come and do the same. And the last one is our simplified go-to-market strategy. Just like I said, their go-to-market strategy is that we'll sell through Google, we'll sell through Facebook, and we'll do it faster, we'll do it simpler. If you can do it faster, somebody else can do it 2 times faster. That is not go-to-market strategy.
It's great, but some of those are actually quite easily fixable by coaching or something like that.
Yeah.
Is this something that is not completely considered, or I mean, like 20 persons in the office typing in manually, that can be automated pretty fast, especially nowadays when you have AI.
Well, it depends. It depends. Not always, but.
But in many cases, you can test the market, and that is
Yes, that's true, and that is what Reima said. That not everything is like 100% no or 100% yes. We evaluate like how important is it. If it is just for testing the idea, who cares? Like 20 people can work in the back office and act as a AI. But if the idea does actually work, then we just consider how much would it cost to automate it and to do it. Yeah, of course, because
I would build on that like we had this situation in Bard. Like I said, their tech stack originally was this Google Sheet and WhatsApp, and the idea was that they test the market and then they build the product. And that shifted our due diligence focus that can this team deliver the product? Is there a capable enough CTO? And we looked at the CTO's background, what he has delivered, and okay, and also that what kind, it's not that complex product in the end. So we were able to take that leap, but in many cases you see that the reason why it's done manually is that there is no technical founder in the team in the first place.
they don't know how to
That
do it.
today especially you can do a lot with AI, but then is that, does your margins work out? Are you burning so much credits that you don't actually make any returns? So things like these can sort of pivot from one area that it affects, that you need to focus on something else.
Yeah, that's true. So when we do our due diligence, we do have a checklist that we go through, and these are the main topics. And then after each topic, we usually, when or if you will receive such due diligence that we do, you will see it's divided under 1, 2, 3, 4, 6. 6 different sections, and we give a score, and we give also weight to different aspects. Yeah, like I said, team and execution, we make 50% weights of the project. Then real market, addressable and obtainable market, we take about 15%. That is not that important because the idea that the startup or the company initially starts working, it's never the same idea 2 years later, because the product always changes, because they find that there are different aspects, different niches, more profitable niches. Of course, you have to stick to the main idea, but you can deviate a little bit back and forth. Traction and retention. It's very important that there are sticking customers, paying customers, that you make a platform, and there are many customers who use the free version, but it's important only the paying customers are paying your bills, not the ones who do it for free or freemium. The business model, customer acquisition cost, we make about 10% weight. We really evaluate if the customer acquisition cost is realistic, if it is real to acquire the customer at the cost what they have provided. Competitive moat, is it really that protected, their business model, and the financial discipline. We don't put much weight at it at our stage, which is approximately 5%, because for the companies where we invest and with which we work, we do have monthly meetings with all of them. So we do follow up on their spending, on their income, and so we just and also we transfer the money in tranches, so that just to make sure that they don't buy everything. So next will be a pitch deck for Rebookify. Rebookify is a company which is working initially they said that they work in travel industry. So the travel industry, I'll just tell you what they do. For example, you can book a hotel on booking.com, and when you book a room, then you can pay immediately, and then you pay just slightly a little bit lower price, or you can buy it with an option that you can cancel it, let's say 24 or 36 hours before your arrival date. What these guys do, that they're checking, you just give them your room and your dates, but that's business to business. That's for travel agencies. You give your room and the rate and the dates that you booked for, and in case if during time the price drops, then they just inform the travel agency, and travel agency can cancel the previous or buy a new reservation, then cancel the previous reservation, and they take half of the savings as their profit. So what they said that travel agencies overpay for refundable bookings because they don't follow up their bookings, and that way they miss rebooking opportunities, and in that way they could save 15% of their margin, which could be transferred either to the client or which could be used by the travel agency by itself. And this is how the price could fluctuate. That is for a stay. And so this is the product, how they position and how they sell it to the travel agency, that you booked a room. And it is possible. There are 3 different bookings that they showed that for, I think it was for a week or for 2 weeks, something like that. So you could make a potential save. So this is the copy from their first slide that they showed to us.
Maybe a question. Looking at this slide, the market slide, do you think it's a good slide or a bad one?
Or what mistake you see?
Yeah. Any opinions are welcome.
Just huge numbers, exaggerated.
What is this 1.5 billion?
The hotel and resort market size.
So
What
it's
should be this?
in general market size, or specifically, as you mentioned before, that we need to look just for these.
Because they're telling in which industry they are, but are they in travel and no.
Yeah, the total available is meant to be the 300 and.
What is
So what is the first thing that you read, and they say that the global hotel and resort market is 1 point.
Who has read this and probably make the same conclusions as you have? Can I answer? Yeah. First, I already like hey, this is not, you are not in hotel and resort business.
Exactly.
Your software. And secondly, provided that 1.5 trillion would be correctly, on a gut feeling, no, the hotels are not giving away 20%. So already the total addressable market out of that. And common problem when you do top-down is that you end up with these crazy numbers.
Yeah, because these numbers are just to sell you their meeting. It's not realistic numbers, and that is most probably it's not intentionally, but it's just that they like to be in a market which is absolutely inappropriate for them. So
usually a guide that I give founders, if they ask me how to build this, I tell them that look, don't build top down, don't start the market size and try to build the bottom up what you can deliver, and then please check from top down so that you end up, for example, one company ended up in a situation that their total addressable market was bigger than the whole world GDP. They were also selling to more people than in the world, but that's what Excel gives you sometimes.
But I don't actually even pay attention to this because that is.
So I actually want that you check with the market size, because sometimes you end up on this that, hey, how about it every person uses, and then you sort of make a glitch that, hey, yeah, babies are not buying medicine, it's their parents, they don't have the average income, it's their family's income, things like this. But yeah.
Yeah, but that how I usually look is really at the bottom up. For example, in this case, like which market are you serving? Let's say they serve. Let's assume they serve Baltic market. How many travel agencies are there in the Baltic market? Let's say 300 travel agencies. How many travel agencies can work in the hotel just purely for business to business? Most probably out of these 300 agencies, there are 120 agencies. Then how many agencies out of these 120 agencies can you actually acquire and work with? Most probably it's about 30 agencies, so your market is much smaller but realistic. So you should be looking at realistic market, because you cannot sell this utopia. And then you just start building from the realistic market, just go up and see what your potential could be. Why now? They just tell why is the best timing where to invest. In 2000s, it was direct contracts with hotels and manual processes for booking, rebooking. In 2010s, there was hotels, platforms like Hotelbeds. That is business to business. It's not booking because booking is for private individuals. That is for business to business. Hotelbeds, Hotelstone, Go Global, and there are 5 or 6 such platforms total. And now the price fluctuations are constant. We have dynamic pricing. That dynamic pricing means that the higher the occupancy, the higher the prices. It's that for the hotels, for the airlines, for the concerts and stuff like that, for the taxis on the peak times. And agencies really need real-time data to be competitive and profitable. So now the company has the right time just to enter. It's already growing competition and growing industry. And Rebookify, it just positions itself that they have a very good customer retention, and I do agree with them that customers stick with them because you don't have to pay anything to Rebookify. You just share the profits or the savings that you make. So you don't have any sense or any point of leaving the service provider because he doesn't charge you any monthly fees. They just give you the savings, and then you just split the savings into half.
Maybe also to note, the part about exit potential, it's actually not a thing that you usually see in pitch decks. Most startups usually don't already indicate in their pitch deck the potential exit, because it's usually something that I guess the investor in his own side is kind of calculating himself based on some market trends, etc.
But is it good to identify?
I would say it's good on getting the understanding of the founder's ambition level. But for everything else, well, maybe also that what they say, like here is logical acquisitions target for Expedia. I like the word logical in that one, otherwise I don't like it, but I see a lot of this that then Google buys us. And what I would like to see is not who buys you, but why. If I see that question is already answered, then usually the team also has thought about what is the path that they want to take. But in terms of exit potential, why 500? Why 12x multiple? It can be 20, it can be 6. Why 10% market share? Why not 25?
For our stage, it's too early to know about it. That's first.
And even
And-
ours, for us, we can know if it's too small, but still, I mean, you can put whatever number and justify it.
But I can actually, sorry, but if you see something like exit in the pitch deck, then does it change your opinion about the founders?
Usually, I mean,
It's a conversation topic. I
yeah,
would say.
usually not much. Only if it's for here, for example, okay, ambitious enough, they don't want to sell it at 10 million. 12x revenue multiple, they are in planet Earth, not necessarily on the same country as I am, but at least on the same planet. So I can work with these guys. And I like the word logical. So if this doesn't change much, but it's a bit more like tiny piece positive.
I agree, and I agree on two aspects. First of all, they have already thought about what I'm looking for, because what I'm asking the question, which will be the company that will buy this company? Because I make money, or we make money, on selling this company. And then, like I said, this was the first pitch deck, and they said that they are planning to sell to Booking or Expedia, which is absolute nonsense. They cannot sell to Booking because let's think about Booking. Booking makes money commission on hotels. If the hotel lowers the price, they lower their commission. So they will cannibalize their own commissions. So why would they have to buy it? They will not buy it. But we turned it vice versa into their competitive moat. So competitive moat is like a competitive advantage. So the competitive advantage is why Expedia, Booking, or Amadeus will not do the same service what they do. And this is just exactly the same reason why they will not do it, because they will not cannibalize their own business just by looking for lower prices and for lowering their commissions on reduced prices. And Expedia and Booking will get into the fight with the hotels that they're catching the lower prices and rebooking everything. So that is their, so to say, competitive moat, that those big players, it's easy for these big players to do it, but they will not do it.
I have a question. This pretty much seems like AI generated slides. This comes back to that fraud question we had earlier. I mean, now with AI it's much easier to get you on a fraud through these. And AI can most likely pitch you to how to pitch in front of them.
There is AI doing investor intros, and it's actually tested that platform as a startup. It actually creates me the whole startup if I want to. By the way, it's apparently operating its own fund, if we believe what we read in the newspapers. So yes, everything is possible. But this is like, it's actually interesting done that like what kind of things the AI chase. I mean, I don't care if the founders do the deck, whatever tool is the fastest for them, as long as they convey the message and like all of this stuff. I can sign like about 100% that you have been saying here. Same kind of things we look into come across all the time. But with the AI help, still it seems that like problem with AI is that it's being taught by bad material, and most of the pitch decks are not bad, they are awful. So most of these have the very same problems. So if you're using those tools, you probably end up, unless you use some specialized tools, which are actually pretty good. But in the end of the day, it doesn't change the underlying problem. If the founders don't think like what they are saying in the deck, that will come out anyway.
So it's like trash in, trash out, right?
Exactly.
Yeah, I'm not putting it that nicely. I use the word with
That because basically that's could be one of the reasons why even the exit potential is named there. It's not that.
Actually,
But this was made before AI explosion.
Yeah, I was thinking the
yeah.
same.
No, actually, behind like this exit potential in the pitch himself, and then the conversations after, he actually had a good explanation to all of this mentioned. But if you just take a straight look at it, it does seem a little bit too, let's say, too good to be true, or something like that. Yeah.
Yeah. So at the moment when they came and they pitched to us, they already had 21 clients, which paying clients. Paying because they were paying. The clients were paying the savings to the Rebookify. Yeah? So that was a good indication that they have a MVP. MVP means minimum viable product, tested product. That they have tested the product, they have tested the demand, and that they could make a business out of this. And that is how they showed us what they have achieved.
Also,
Yeah.
maybe something to add to this. The good thing about some of the pitch deck traction slides or the progress slides is, for example, in this case, we really appreciated that they actually placed the logos of their current customers, because it was straight up easy for us to actually, through our member network, to find the owners or the operators of these companies, message them, call them, like, are you actually using this? Are you paying for this?
We did it for 4 or 5.
Yeah, we did
travel
it
agencies.
for 5 travel agencies. All of them confirmed that it's true. That it's useful for them, so it was very easy to kind of understand whether this is kind of just for good picture or not.
I don't want to steal time, but I have to tell one story on this. I got a pitch deck, customers, traction slide, customer logos. I thought, oh, that's one of our portfolio companies. And sent a message that, hey, what do you think of this solution? What solution? I'm going to stick your customer. Let me check with the team. And goes back, no, we are not using it. They have sent us a proposal, we have never answered.
And this is a very usual case. We had like this one HR Tech Tool also, they listed like 40 companies, Latvian like good companies, including SEB Bank and etc. And of course, in all of these companies, we have some connections that we can speak to. And one of those companies, two of those companies was actually run by one of our members, both of them. We messaged him, he got us the contact of their HR lady. We messaged the lady and she's like, we were considering them, but not really using them. So it's kind of, dangerous game to play with. Yeah, fake till you make.
Yeah, this is their go-to-market strategy. So they started just with their first client and what platform the first client was using, and then they were adding on more platforms, and the more platforms, the more clients, of course, they can acquire. And at the moment, they have, I don't know by heart, but something like 5 platforms and 40 travel agencies onboarded. Yeah? And so at the initial stage, they planned that they will charge 600 subscription model, which is not active business model at the moment. They just take 50% of all the profits because clients were not willing to pay 600 subscription. And then what else? This is the team. And you should also pay very close attention, because only these 2 top guys are the founders, and these 2 guys are the ones who are doing the business. And people usually like to put very nice pictures of very recognizable and important people, like investor and advisor, but keep in mind that advisors are not selling anything. They're just maybe getting in touch with the company once a month and maybe advising something. So you should be paying attention to the track records of these top guys who will be delivering, because advisors are not going to sell anything or develop anything. They might get very good networking, that is true, and that is very valuable, but they will not add very much to the company.
So do they say that it's co-founder and investor? This means that they already have some dilution in their company or share?
No, he just put in the money, cash, and as a founder, but he's not acting founder. He's
they had
He's one of the 3Fs.
Trees, yeah, he's like a family.
They had like an interesting story that these 2 Lithuanians invested in Matis during one accelerator program. As a person, there was no idea at that stage yet, so it was a kind of bet for the future company. So that's why they also kind of showed at that point that they are co-founders of the project. Yeah.
It's usually this kind of when there is the founder investor, at least for me, it's once again that okay, extra attention. I open the cap table and okay, do they have investor stake or founder stake? If they have founder stake, my next question is that okay, what these guys are actually doing, and then I treat them as a founder team, so they need to sit in the same discussions, and usually it's more of a warning sign. If it's a small in the cap table, okay, it's like any other investor. I mean, my face has been in those several times just to give a bit more credibility and sort of that, hey, the next investor actually reads it. There has been one time that I've let this kind of advisor, founder, investor be with a significant stake, and the reason was that for the business of the company, he has exited his previous startup on a unicorn level to AMD. So sort of that, okay, if he is involved in 1 day a month, he is still an important guy. But usually it's whenever there's those names, is once again extra reasons to be careful.
But these guys actually, Gintautas and Vytautas, they were important guys. We also checked them. They had a very good network in Lithuania. So they were not actively involved, but they were valuable.
It's basically what they provide versus how much they own.
Yeah.
And unfortunately, quite often is that, hey, I help you to polish your pitch deck, give me 5%. And then you have these very useful advisors whose only contribution have been to policing that first pitch deck, but then they own the cap table more than what you do after the first round. So
That's true, yeah. Then competitors also, like, you check how they look at their competitors and what they think the key advantages of their competitors are, and how competitive are they, or what is their competitive advantage over already existing competitors, because there will always be competitors. Like in this market, it's the travel agencies themselves who can put one lady who is constantly checking for the prices once per hour. That is also a competitor. So they just analyze the MyStack, which is their competitor.
Maybe
Just yeah.
an open question. Do you consider this as a good competitor slide? Like, if you take a look at from the outside perspective, does it give you enough to, let's say, have a better picture of the market situation?
I would like to know how many companies are there. Like that.
Market share, okay.
More kind of matrix, kind of like
I would say,
positioning kind of
yeah,
picture.
yeah. I would say this is a kind of a very limiting competitor comparison because it doesn't really outlay the main advantage of Rebookify against, let's say, the MyStack or the Go Global, because it doesn't show all of the platforms. They just took the biggest competitor that there is in the market. Yeah.
Mm-hmm.
And
And
they then put themselves.
They put
No,
themselves
they
in
put
the
it on
left
the bottom.
corner. Yeah.
And it's not. It's never that you have only two competitors. It's then you have to be Boeing and Airbus, but even they have competitors. According to this slide, so they raised 400 investment to reach 100 business customers in 18 months. It's been, I think, 18 months already since then, and or no, or 12 months, yeah. So far they have about 40 business customers, so a little bit lagging behind. And they're planning to generate 60,000 monthly recurring revenue. At the moment they have, I think, 10,000 or something, or 12,000. This is just to say, to show you like how they pitch slides usually.
Also, maybe just to note, in terms of the ask slide, usually the last slide on the deck, I would say this is a decent example because it states pretty much how much you need money, in what time frame you will use it, for what you will use it, and what it will kind of get you. Basically, yeah, the 100 business customers, the 60,000 monthly recurring revenue, and you need 400,000 for that. Usually you will see a lot of decks that actually are missing many of these parts. Some of them will just say, hey, it's like I need 500,000 for, I know, pilot processor. No explanation given on what timeline will you kind of be doing it. How will all of that money actually be going to the processor, or there's also some other parts missing. But the perfect example, I guess, would be if there would be also a valuation listed. But again, that's always a debatable topic.
That's what I wanted to say, that there is one very important thing which is missing. You're buying a car, but you don't know for what price you're buying. Because if you're investing 400,000 into a company, then you should know what kind of share or how much of the company you're buying.
Or at least how much the seller is asking for it. I mean,
Or,
at the end of the day, you can.
I mean,
but for instance, if I would get, and I think actually that was when I got this back in the day, that was one of my first questions, that, hey, valuation please. Just for me, I mean, it's always negotiable, but I want to understand if we are in the ballpark or not.
Yeah, yeah. There are, of course, people from outer space who come in here, but you have to know like exactly if it is reasonable or not. And yeah, they're planning to go to UK customer case. Now they are in UK market as well, and that is what their strategy looks like. I'll just quickly just go through the slides and good versus the bad. This is that was
that's
that
already
was
yeah.
that was
We will continue that part in the next session. We have prepared a long list of different slides from different startups, and you will have to explain why they are good or not. But I guess we can delay that to the next session. Yeah. But all in all, thank you, Gift.
Thank you.
And if there are any open questions that maybe are not yet answered, if not, we can just head into the networking, and then you're free for the rest of the evening. Yes.
Yes, I have a question. Now it's like the market is super fast changing in AI agents. Like, for example, ChatGPT came out and it was like a chat buddy. Then it had some functionality which is nice. Then other chat apps or sort of search engines came out that can do stuff. Then ChatGPT started to have opportunity to generate nice texts and documents and legal and financial analysis. But for example, like Cloud came out, Cloud Code, it was like nothing in the market exists. Boom, after 1 week, all the software developers are like truly understanding, fuck, it's fast. 1 week, totally disrupting the market. So something like this, great business, but what if you can build a chat bot agent, in almost like free or $20 app that you pay already anyways, that can screen scrape from your computer.
There's always the risk of it, but for example, in this case, it was always like one of the biggest risks that we considered was this platform dependency. But in Rebookify's case, they're a little bit, I would say, protected from, let's say, these basic scrapers, because the integrations that they make with these platform providers, the B2B ones, they are all custom. They're not like standardized. You cannot like access them freely. They are all like relationship built, custom integrations. So that was kind of, let's say, a little bit of a barrier to entry, let's say, for new tools in the market. But yeah, I guess this is a very common risk.
But that is becoming more and more scary, the AI, because it can just, like I said about biotechnology, it can just take away your business just overnight. And I can give you an example of another company, although we did not invest in it, that was Lexu AI. Maybe you have heard about it, maybe not. It was a legal tech company. And we're also asking like them, but what if the new AI agent comes out, legal agent, and just takes all your work? And they had also thought about it. And in legal space, I didn't know that, but during the due diligence, all the court rulings are publicly available. So, but they're not published. So Google or ChatGPT or Cloud cannot get them because they're not published. But if you go to, I don't know which institution, and ask them, can I get a court ruling in this case? They will give it to you. But it's not officially, it's not published on the internet. You cannot get it.
Yet.
I'm sorry?
Not yet.
Perhaps, yes.
Well, I would say depending on the country.
It depends, yeah.
That it's just there's not benefits. So
It depends. It depends on the country, and it depends on which is it criminal case, is it competition law, is it human rights law? It's also, but they were into competition law, and competition law most probably will never get published because it's a very, very niche area, and that is how they protected against AI coming in and just taking their business out overnight. Of course, we're thinking about it. It's very big threat.
These are more the kind of questions we need to think about. And actually, like I said in the beginning, we invest a lot of marketplaces, and we have been thinking about what this agentic buying will mean. I mean, it's clear that it will kill marketplaces. If we think about Bookify, Booking.com, I already mixed it with too many fire-ending startups in the world. Right now, hotels are there because they have to be. But already, how I'm doing my bookings, it's Claude, find me a hotel near this place next week when I'm doing the Latvan. And yeah, they can see from my calendar it's there. And it's already pointing, if I would do it with OpenPlot, it would actually could go. Tallink Hotels website works already. But today, most of the hotel website doesn't work. But of course, every bigger chain is gonna change their website so that it's agent ready. Which means that what's the need for booking anymore? But if you think where Rebookify is, it's on this B2B side, first of all, where first the use case is still heavily that, hey, we have a group of 20 coming from a trip, so you call. Bookings like that, doing online, being it ready for agencies, it's a whole different game. So it can happen, but
Not that fast.
it's not the first one, and I mean it might be Rebookify who's the one doing it, actually. But for instance, on our portfolio, we were really thinking, because a lot of marketplaces, and well, will all those be dead? Not looking good for the returns. But we realized that actually most of our marketplaces are C2C, not B2C, but C2C. And yeah, it's easy. If I have a hotel, yeah, I can go directly from the hotel and scrape the information from there. But we have marketplace for second-hand electronic vehicles. I cannot find an agent that finds that Emil has the kind of car I want to buy. There you still need the marketplaces. But these are the kind of questions that when we have this kind of technological disruption, time to stop and think what it means. And for instance, on legal tech, I've been super scary what it can do, but also realized on this that it really depends on jurisdictions, what information is available. Love to build myself a Finnish tax lawyer bot because all the information is available. Plus, as a former tax lawyer, I remember how ridiculously expensive I was. So maybe I could disrupt that market once, but fun times.
What is missing for me as an outsider in this case, what is going on with the travel agencies market? I mean, is it still a business? Is it where do we see travel agencies in?
It is missing from the deck, but it was, I think, explained in the conversations by the founder. But again, it's a dying market in a sense, but still existing one that will probably still be kind of concentrated in a certain audience.
But here, if you think about that, why certain businesses get disrupted so slowly, it's usually that it's complex and it's niche. So niche meaning there is not Google coming in and putting hundreds of millions to solve it. And it's complex meaning that it takes more than my IT skills to build something. And I think travel agencies is a good example, especially on business travel, because of how many of you has worked in a corporate and somebody on your team has done bookings for you?
Yeah.
Think about what it means for you. You just said that, hey, I'm gonna go to this conference. Then somebody, your assistant, calls to the travel agency. It's already like changing this kind of business model.
You just go and book yourself.
Not happening at EY, I can tell you that. I never get my money back if I would do it like this.
Why did you?
No, they have. I think they have these corporate solutions, like have a corporate.
Some do, some don't. But and this is that anyway, like it's very old-fashioned. So, and if there's this that hey, I'm used to that, I can only tell to my assistant to do it. It already becomes more complex to start chasing it from the end cost, like the agency side.
And that was one of the slides that I was telling that what is your competitor, and one of your competitors is your customs, how you're used to do things. If you're used to that your assistant calls, you will never switch to something else, even though it's faster, cheaper, better.
You had a question?
Why did you drop the Lexio case? Market size?
No. That was that's also one of the slides that. That's no. I mean, I can tell that the business was really good, but the founder was too young.
I would say a little bit of uncoachable.
Uncoach, yeah.
And
That's
plus
precisely.
also there were two huge market players already in the US and Europe that were kind of, with the amount of funding that they were getting, which was in billions, it was a little bit, let's say, hard to see market share potential for them, let's say, in a very fast timeline.
It's actually interesting to compare notes. We have also passed this case in the same round, so for us, first of all, it was too early, so it was sort of easy call. And secondly, we came to the same conclusion that sort of first of all, we want to invest in a market that is growing and preferably is growing from 10 years now. And I mean, this is a nice protected market, but I'm not seeing it growing. And there were well-funded competitors already.
Yeah.
So.
Because now there are those two players, they're taking also the niche markets which Lexo was or is targeting, yeah. So let's see.
But just to invest to that guy, develop the business, and then sell it to one of these two competitors, and then the competitor.
It would be easier for the competitor to just squeeze them out. Yeah.
That kind of strategy might sometimes work, but then it's always on the buyer. I do quite a lot of trainings on exit side as well. For the buyer, it's always a question that, hey, which is more valuable for me, buying this company or building it myself? And the thing with building it ourselves is that first you think that it happens faster, it takes 3 times longer, you believe it's cheaper, and then you believe that it's as good or better. So basically, only situation when you end up buying in these kind of scenarios is that you are really worried about that you are missing a market opportunity. So for instance, I did my best angel exit in a situation where, because of COVID, all of the online training solutions needed a virtual whiteboard. And we had a virtual whiteboard with 8 million monthly active users and 2 million in annual revenue run rate. At that moment, Kahoot called us and put a crazy offer on the table. I'm like, okay, we will take it. But they figured out that they get a bit of users, there's a bit of cross-selling, but most importantly, they are not missing 6 months with their existing user base of tens of millions. And for that reason, they sort of overpaid if you look at only the numbers. But as a strategic move, I think they did the right thing. For me and founders, we're happy.
Why is it always like everybody, the first day and today, are saying a single founder is like evil?
No, he's not an evil.
What if you are not as genius as he is? Like
I am not, I'm definitely not.
uncoachable word. Like everybody probably remembers Mark Zuckerberg in a meeting with the investors said, I always yawn when it's interesting. He was a fucking asshole, but look what he become.
No, I mean, with single founders, I always like the saying, like the bus factor. What happens to the business if one day you walk over the street and a bus hits you?
So was your comment about solo founder, or was it our negative view of founders in general?
Both.
On the solo founder, I'd just say it's added level of risk. I mean, on average, one founder on a startup bursts out in 4 years. And if there's nobody else to pick the pieces, that would mean that I have additional 20% chance of the company going bust. So it's simple mathematics on that point of view. Then this negativity partly comes that 97% of startups never get any funding. Okay, this is Finnish number, but 97 never get any funding, and all of those come to pitch to you. So unfortunately for us, when we see too many decks, is that we focus more, especially when the training is about due diligence and screening, we tend to focus more on the negatives. But the 3% who gets the money, they are really top notch. And what it means to be top notch is that it's not about that you are playing football in the Finnish national team. It's that you start with Messi in World Cup final. That's the level where they need to be.
Great comparison.
But the burnout is really, really important factor, and over like 5-6 years that I'm doing investments, I've seen a number of teams where the guys have just burnt out and not just tired, but basically you're scared of him and how he will just last, and that is really serious.
It's a real issue. For example, one of the most notable Latvian startup exits was Nordigen, who were acquired by the UK company GoCardless. And I've spoken to both founders several times, and they have said very publicly, also in different discussions and events, that if it wasn't for each other, they would have definitely been done with the company, because he said that throughout the 9 years or 7 years of building the company, they had reached their personal burnout levels to the maximum. If the other person wouldn't have, let's say, stepped in or kind of a little bit pushed them a little bit more or motivated them a little more, it would have not succeeded in any capacity. Yeah.
But isn't it that in many cases, 2 co-founders, 3 co-founders, there's only one that matters. The other ones are more of assistant type.
Ideally, I mean, this is actually a problem, and I would say that it's quite a lot of problem in Nordics and Baltics. It's less problem in UK. It's definitely less in the US. On average, we don't have strong teams. We have one strong founder, but they haven't been able to find that strong co-founders. But I mean, it takes a bit away the risk, but then again, there is still only one on that. But maybe also what Emil was saying, I used to be entrepreneur myself, and that affects my thinking, because if I would start a startup alone, I wouldn't start it. I mean, I was too much of a pessimist. And if my co-founder, and he did start a startup after we exited our company, he started that alone and did okay, raised over 10 million, burned it all. And that was his problem. He was the over-optimistic one. Together it actually worked out because we balanced each other off. We fought a lot, but when we finally agreed on something, then we knew that we are onto something. And usually you want that the founders are enough in the extremes to deliver extreme results, but then they also need somebody to counterbalance. Of course, there are some superstars who can really cover everything, but for instance, I don't think Mark Zuckerberg would be where he is now without Sheryl Sandberg to balance himself as a COO.
All right. Thank you very much for this.